Section 5, Sources of Funds. Unit 1, Commercial Sources of Funds. Unit 2, Other Institutional Sources of Funds. Unit 3, Private Sources of Funds. Unit 1, Commercial Sources of Funds. Lesson 1, Mortgage Funding from Commercial Banks. Lesson 2, Life Insurance Companies and Real Estate Funding. Lesson 3, Credit Unions and Real Estate Funding. Lesson 4, Mortgage Brokers and Bankers. Mortgage Bankers versus Mortgage Brokers Showdown, Transcript. Announcer, please give a warm welcome to your loving mortgage banker and handsome mortgage broker. Let's start with you, Shonda. Shonda Morellis, hello. Are you ready to have a little fun? I'm Shonda Morellis, and I'm going to tell you why mortgage bankers are the best. Bryce Gribbs, hold on there, let's not get too hasty. After all, Bryce Gribbs, think we all know mortgage brokers are the best. I beg to differ, Bryce. As a mortgage banker, I'm directly involved with each and every loan I originate, and I originate each loan myself. But as a mortgage broker, I don't have to mess with all the paperwork involved with originating loans. My work is about building relationships. I guess you could say I'm a matchmaker because I connect borrowers with the perfect lenders for their needs. It's funny to hear you say you build relationships, considering how quickly you exit the picture once the borrower and lender are connected. My job is all about relationships because I stay with the loan for its entire life cycle. BG, meaning you have less time to move on to the next deal, and fewer opportunities for making money. I facilitate relationships and yes, once the deal is set, I get out of the way. No one likes a third wheel. My customers always know exactly what to expect. I'm involved with my community and contribute to my local economy by having my business right here in town. BG, I contribute to the local economy plenty, but because I have a network of lenders all over the country, I'm free to go where the business is, and not be tied to a single lender with a limited set of loan products available. You might have 40 loan products in your bank, if that. Multiply that number by all the lenders I work with, and you can see the consumer choice is exponentially better with a mortgage broker. Part of the reason I'm so invested in the relationship with my borrowers is because I personally fund most of them. On larger projects, I may work with a local bank to establish a line of credit. I have a stake in my client's success. BG, what a nightmare. I don't invest my own capital. You want to know why? Because I don't want to risk losing my shirt. Let the big banks do it. I get paid a placement fee for matching borrower and lender, so once that connection has been made, I'm off the hook. Well, it looks like we'll have to agree to disagree. Let's just say that you have your place, and I have mine. BG, yes, and mine's better. Is not. BG, is too. Is not. BG, is too. Credit unions and real estate funding. Federal credit unions were established in 1934 by President Roosevelt. Credit unions finance mostly personal property loans, e.g., auto loans, and traditional mortgages. They also participate in the secondary mortgage market by pooling their mortgages into real estate mortgage investment conduits, REMICs. The National Credit Union Administration, NCUA, was established in 1970 to charter and supervise federal credit unions. Credit unions have national deposit insurance under the National Credit Union Share Insurance Fund, similar to that provided for commercial banks under the FDIC. Credit unions present serious competition for commercial banks. Because of their non-profit nature, they have fewer regulations and more flexibility in lending. In 1998, President Clinton authorized the Credit Union Membership Access Act. This opened the door for credit unions to recruit members using much wider criteria, leading to huge growth in the credit union sector. The role of life insurance companies in real estate funding, transcript. Welcome. Please, come in and get comfortable. I'm Melia Jackson with Safeguard Life Insurance. No deodorant jokes, please, we were here first. Let me tell you about the role life insurance companies play in the real estate funding process. Are you surprised to learn we're even involved in real estate funding? When I first started studying for my career, it surprised me too. The insurance industry generates billions in revenue annually and is one of the largest revenue-producing industries at both the federal and state level. At Safeguard, we invest in municipal bonds, purchase blocks of single-family mortgages from the secondary market, invest in commercial real estate, and provide many large businesses with the money they need for expansion or new research. Life insurance companies like ours make investments for the long haul, so we're not too concerned about liquidity, but we're very concerned about the long-term stability of every investment we make. This means we don't get into single-family real estate funding, we leave that to others, such as commercial banks. We prefer larger projects, such as high-rise buildings for shopping malls. These structures tend to have greater stability of investment over a longer period of time. Also, we often take a sort of partnership approach on the larger projects. This is known as participation financing, and it gives us partial ownership and greater revenue potential in exchange for providing financing for the project. So, as you can see, it's not just about insurance policies. Commercial banks and mortgages script. Welcome to Vital Funding Bank. I'm Schaefer Mills, Bank President. I understand you're learning about sources of funds and the role commercial banks play in funding real estate transactions. That, seriously, is one of my favorite topics. Goes over well at cocktail parties, as you can imagine. Let's start with where this bank gets the capital to participate in mortgage financing in the first place. Do you have any idea what our primary source of capital is at this bank? Well, really, all commercial banks? Would you believe this? He holds up a checkbook. The main supply of funds for commercial banks is demand deposits, also known as checking accounts. Crazy, right? Checking accounts are not the only source, but they definitely provide the majority of funds for us to conduct business. You already know that we participate in the financing by making traditional loans secured by mortgages, but that's only one type of real estate funding we can provide. A large part of our real estate loan activities involve interim financing, construction loans/mortgage loans. They're known as interim financing because they're shorter in length. Depending on the size of the project, most will have payback terms of between 3 months and 3 years. We also offer home improvement loans. As you might guess, these loans are used for improvements or modernizations, such as adding a new garage or remodeling the kitchen. Some commercial banks also provide funding for manufactured housing/manufactured homes. The more permanently attached the home is to the land, the longer the loan term. Can you guess why that is? Well, without going into a whole spiel about manufactured housing, I'll just say that if a mobile home is attached to a permanent foundation, then it becomes real property, and therefore has more financing options. Makes sense? Another way we participate in real estate funding is through home equity loans. These loans are based on the existing equity in the borrower's home. Some of our customers use home equity loans for home improvements, but they don't have to. These funds can really be used for just about anything. So those are the major ways we participate in real estate funding here at Vital Funding Bank. If you ever have any questions, please call me. Like I said, this is one of my favorite things to talk about.